Whether you know this or not, one of the greatest obstacles that a trader has to face is his own ego. And over the next 2 chapters, we will discuss the fears that the trader will face when venturing into the world of online trading and how to manage them. What's the difference between investing and trading? Well, if I were to answer that, I would say frequency comes to mind. Trading is a fast-paced activity which requires monitoring, while investing is pursued on a much longer time frame. Investing is for growth and dividend yield, while trading is to generate a profit. I believe that the major difference between traders and investors is how each manages the risk involved. Investors, they'll manage risk largely via diversification. 10 well-chosen shares can be managed with less risk than 1 share, and that's the basic tenet of modern portfolio management. While traders they'll manage a risk via a stop-loss order. And there's somewhere when a trader is looking on the chart where they say, if the market comes down here, if the market comes up here, I am just wrong and I need to get out of the market. Have you ever given any thought to what actually makes a successful trader? What ingredients go into making a profitable trader? If you ask me, I believe then you need to consider the 3 M's. You need a method. And in a later chapter, you will be taught a complete trading method, which I myself use extensively in my own foreign exchange trading. The second M is you also need to know how to manage your money. Because without money management, you're playing a game which can't be won. And finally, you need to manage yourself. My old trading mentor, he used to tell me that managing my emotions was more than 90% of the game when it came to trading. And being able to manage your emotions under pressure, that takes a lot of practice and a willingness to learn and accept that you're not going to win every single time that you pull the trigger and place a trade. Money management is by no means an easy topic to teach. First of all, there is a general reluctance by traders to apply any kind of money management to their trading. Secondly, most traders come into the trading arena generally believing that they will not lose money. But unfortunately, the facts they tell a different story. The facts they state that most people come into the trading arena will at some point, they will suffer a significant setback, which is actually completely unnecessary and avoidable if they just followed a few simple rules. What most newcomers fail to accept is that there is a degree of randomness to the financial markets. Let me attempt to make that clear with an illustration from the old flip a coin game. You know the game I'm talking about, you choose a side and I flip the coin and you choose heads or tails. You know as well as I that at the outcome over hundreds and hundreds of throws, there's a 50-50 chance of a head or a tail. So if you were to throw the coin 100 times, you would expect 50 heads and 50 tails, or something close to 50-50. The result may vary a little bit, but not significantly. But is there the same kind of order when you're just throwing the coin once? Is there the same kind of predictability? Yes, the outcome of one coin throw is 50-50, but the reality is that I have no way of knowing if the next coin throw will produce a head or a tail. And as such, there is complete randomness at the outcome of one event. But there is perfect order in the outcome of hundreds of coin throws. And I'd like to illustrate that a bit further with an example from my own trading. I decided to throw a perfectly normal coin 100 times, and then I wrote down the outcome for each throw. Yeah, I agree with you that that is not the most exciting experience that I ever come across, but the result was very significant. It was so significant that I repeated the experiment 3 more times just to ensure that I hadn't got lucky the first time around. The result that I found had a huge impact on my own trading, and I'd like to share the result with you now. My first 100 throws, they gave me 51 tails and 49 heads, as close as you can come to 50-50. And since the coin game is a 50-50 experience, you would expect an outcome like this. However, what is hidden underneath those seemingly predictable numbers is the fact that I hit 8 tails in a row. And in the same 100 throws, I also had 6 heads in a row. My second trial of 100 throws was even more interesting. This distribution between the heads and the tails were this time 48 heads and 52 tails. But the internal distribution was even more skewed than on the first 100 throws. This time, believe it or not, I threw 11 tails in a row during this experiment. And I also had a series of 7 heads in a row. So what does this mean, and why is this important to you and your trading? Well, imagine you're playing the coin game with me, but we have slightly changed the parameters of the game. As a matter of fact, we're playing a game where every time you accurately predict the outcome of my coin throw, you will receive £10 from me. But if you get it wrong, you will pay me £5. Would you play this game? Before you answer this question, imagine the following scenario. We're playing the game and you have chosen heads. I throw the coin and for the next 11 throws, I hit a tail. Would you carry on playing the game? You have lost 11 times in a row. Would you still want to play this game? I have taught thousands of people how to trade, and I have taught thousands of seminars, and when I ask them this game, most of them say that they would not like to play this game any further. But the fact of the matter is that this is a great game to play. As a matter of fact, this is one of the best games to play because it has positive expectancy. It is a positive expectancy system, but you hit a cluster of bad outcomes. But that hasn't changed the overall expectancy of this game being a 50-50 system. Now we know that a coin game is a 50-50 proposition. Therefore, we can expect that you will have 50 bad trades, if you don't mind me saying it like this, and 50 good trades. On 50 trades, you'll lose £5, and on 50 trades, you'll make £10. So overall, statistically, you're going to make £500 on 50 throws, and you will lose £250 in total on 50 throws. So all in all, adding everything up, in total, you should statistically end up with net £250 in your pocket. And that is called positive expectancy game. And it has everything to do with trading. Let's imagine that there wasn't a coin game, but it was a trading strategy. And for the sake of the argument, you had extensively back-tested it, and you were confident that this would work out over time to your advantage. Would you be upset with 11 losing trades in a row? Well, I have no doubt that you may suffer some discomfort. I don't like losing 11 times in a row, but the fact of the matter is that even trading a system with a 70% hit rate, you will experience clusters of bad trades and clusters of good trades. And no one knows when those clusters will appear. They'll come out of nowhere. You will feel like you can't go wrong. You will feel like that every single trade that you place is bound to be a winner. But the opposite will also happen. The money is pouring into your trading account, or they may leave your trading account faster than you like to. But that is the nature of a cluster. You hit a cluster of bad trades and you begin to question the system. You wonder if you're cut out for trading. You wonder if you're cut out for this business. Have you got what it takes? Is the system no longer working? Is it you who's the problem? And I say to you, relax. That is the nature of this game. You have to learn to deal with these clusters. Trades are randomly distributed. They don't come in one win, one loss, one win, one loss. You can't predict in advance if the next trade is a winning trade or a losing trade. And you have to learn to accept that in the outcome of one single trade, there is complete randomness. But the good news is that over the course of hundreds of trades, there is statistical order. I can't emphasize enough how important this concept is. Most traders will grow disheartened with their system after a string of losses. But if they only knew that this is perfectly normal. They probably would have stuck with their system in the first place. Instead, they abandon their method and they try something else. And that's a real shame, because all that really happened was that they hit a cluster of bad trades. And the fact of the matter is that the internet is full of trading systems for sale which have high hit rates in excess of 90%. One of those systems that I looked at had a hit rate of 99%. That means that it promised you would make 99% winning trades and only 1% losing trades, and that sounds great, doesn't it? But don't be fooled. This system uses huge stops and takes very small profits. When I looked into this system, I discovered that the hit rate was correct. It was indeed 99% hit rate. The problem was that when it was right, it only made 5 pips. But when it was wrong, it lost 600 pips. And if you do the maths, 99 correct trades making you 5 pips, well, if we round it up, you would have made 500 pips, and that sounds great. And then you would have one trade that lost you 600 pips. So as soothing and as pleasing as it sounds to have a hit rate north of 80 or 90%, it really doesn't mean anything, nor does it guarantee you that you will make money from the system. As a matter of fact, I once read that some of the hedge funds applying trend following techniques have a hit rate in the 20s, but they still manage to make money from their trading systems. The decision of how much to speculate, how much to wager every single time you place a trade is the most important question in trading. The bet size or the stake size or the trading size is the difference in pounds between your entry point and the stop loss which is appropriate when you place the trade. We're playing a 50-50 game with a 2-to-1 risk to reward ratio. That concept is called position sizing. And it was a gentleman called Ralph Vince who attempted to create the optimal formula. He called it Optimal F. He has written 2 books on the subject which are really not for the mathematically challenged. His books addresses the arithmetic optimal position size, which is known in trading as the Optimal F. I find Optimal F myself somewhat aggressive emotionally and firmly believe that your risk on any one trade shouldn't be more than 2 to 3% of your account size. What I think is very important for you to understand is the probabilities when you are looking at entry and exit. And I'll look at the probabilities of the game to justify that statement next. Let's take a look at the probabilities when you are trading a 50-50 system. If you have a 50-50 outcome on a positive trade or a negative trade, the probability of 2 losing trades in a row is half times a half or a quarter. The probability of a cluster of 3 bad ones in a row is a half times a half times a half, which is an eighth. This means that in a 50-50 system, if you bet 1/3 of your coins, i.e. of your account size on any one trade, then you will go broke every 8 trades. And that's really not in your interest. Many small traders go broke even though they have a great system because of a run of bad luck, which incidentally is a mathematical certainty. A run of bad luck will take them out before the good streak starts. The first thing you need to do when you turn on the computer for the trading day is how much money is in your account. Very few people decide on this. They believe the euro is going up and they buy lots of it. It does not go up, and before they can trade again, they must top up their account. And that's really not what we're trying to achieve here. The only thing that affects the risk of a trade is the account size and the position sizing model used. It's got nothing to do with the euro going up or down on the day. So your first decision of the day is if you don't decide and commit to an account amount and the size of your position properly, then you're gambling and you're not trading. And that is the most important aspect of your trading. You can't control market direction, but you can control and decide upon your risk. This will keep you alive in a normal losing streak without too much drawdown and ready to profit from the winning streak, which is always just around the corner. The most important thing in trading is to have enough money to trade tomorrow. Take a look at this table on probabilities on 3 different kinds of trading systems. There's a 50-50 system, there's a 1/3 to 2/3 system, and then there's an 80-20 system. This table summarizes the relationship between the hit rate of the trading system and the probability of a streak of poor luck. This will help you work out how much drawdown is probable with your trading system, assuming that you have the data correct regarding its hit rate. Clearly, a higher position sizing model will be possible with a high hit rate system. But the question is, can you do this? I hope that if I have convinced you that if you watch and control your position size, then the coin game is a great game to play. The question, of course, begs is, why is this so difficult to translate into your own trading? And we will deal with this question in the chapter on risk management and trading psychology. Assume your account size is £100,000, and furthermore assume that you only wish to risk £2,000 per position. We'll let N be the number of shares. We also know what our risk is going to be because we know where we're going to get into the market and we know where we're going to place our stop loss. In other words, if I know that my risk is, for example, £1 per share, and I only want to risk £2,000, it stands to reason that I can buy 2,000 shares, because if I get stopped out of the position where my stop loss is, I will have lost £2,000 or 2% of my account size. The final component in a trading strategy is you. After method and after position sizing, the final aspect of our trading strategy is that we have to consider ourselves. It's all about thinking in probabilities. Now, this should not be judged over just one trade, but over a series of trades. I always tell people that you're only about 30 trades away from being the trader you want to be. And when I train people how to trade, I often find that by supporting them and guiding them, it only takes somewhere between 10 and 15 trades before they lose the fear of trading and before they lose the fear of losing money. By then, they are perfectly happy with the fact that not every trade they place is a winning trade. In my eyes, they have learned to play the game of trading over and over without any fear, without any hesitation in placing trades. And the chapter on trading psychology is all about how to get to that state of mind.